This is Ron William, technical strategist from MIG Bank based in Switzerland, and today we'll be discussing volatility cycles and the impact on risk appetite. And so looking at the real measure of volatility, the VIX, which is based on the S&P 500, we can see here that volatility is the lowest it has been since pre-2000 financial crisis. Now, from a seasonal perspective, we should expect volatility to increase during the second quarter and third quarter of this year, 2012. One thing to keep in mind is that the new normal has triggered higher frequency and greater magnitude of volatility. Basically, things have been moved pretty quickly by large amounts since 2007, and that's the big spikes that you can see there highlighted in yellow. So we should really be risk averse for these big spikes in volatility. Now, what do these big spikes in volatility mean? Well, if we do get an increase in volatility over the next few weeks and months, we've already seen an increase up into the 20 level, we should really expect a broad deleveraging across popular, overcrowded, risk-centric portfolios. So all the popular uptrends that we've seen from last year into the first quarter of this year are likely to have healthy pullbacks from this, from just general profit taking, but also from this likely increase in volatility. And so looking at one of the most important proxies out there, the S&P 500, we can see that the recent sell-off is now verging on a new breakout pattern support, just highlighted there in light blue. Now this suggests further mean reversion risk into the long-term 200-day moving average, which would basically trigger another 7% downside setback into that moving average. Now, one thing to keep in mind here is that extreme optimism currently that we're experiencing is very similar to the same type of optimism that was witnessed in July of last year, which actually led to an 18% setback in just 2 weeks. Now, that's not to say that history will repeat itself exactly the same way, but it is still nonetheless an important benchmark to keep in mind. Based on cycle analysis, I feel that this move has already been triggered and is likely to unfold during the second and third quarter of this year. Of course, price confirmations is critical, especially in such a volatile market, and so we would expect price confirmation beneath this renewed breakout pattern, which has just been recently redrawn after the recent sell-off that we had early on this month, and that's just roughly below 1360 on the S&P 500. On the upside, of course, a negation of this view, or for this view just to be put on hold, we would need to push back above the March highs there. Now, one of the sectors, especially in the US, which is likely to be due some downside setback, is the US technology sector, the NASDAQ, which has just recovered half of what it lost since the 2000 technology crash. I'll repeat that one more time. NASDAQ has recovered half of what it lost since the 2000 technology crash, and that's roughly around 3120 on the NASDAQ composite. Now, as technicians and investors and traders, we all know that price has memory, and this historical level will likely act as an important resistance level. One important point here is that hot money has reached new extremes as Facebook prepares for its historic 100 million IPO, and this event in itself serves as a potential contrarian signal when juxtaposed against this historic backdrop of the NASDAQ hitting this key level at the moment in time. Now, Apple is a wonderful stock to maybe use as a proxy, certainly within the technology sector, but also within the economy of the US. And Apple's irrational acceleration is unsustainable in the short term. We have a DeMark exhaustion signal just at the top of the chart, favoring a healthy mean reversion into key support levels, just highlighted there. These support levels also act as classic gap areas on the chart where we might see some mean reversion risk. And one point to keep in mind is that Apple serves as a major indicator of economic health and will trigger ripple effects once volatility starts to rise. I think maybe towards the end of the third quarter and certainly into the fourth quarter, the weakness that we are likely to see, the cyclical weakness that we are likely to see across risk proxies such as the Western equity markets, especially the US and maybe Eurodollar and Aussie dollar and gold and so on, will set up a buying opportunity within the end of Q3 towards the fourth quarter. Now, there's a few reasons why this will likely happen. One, having depreciated from high levels, it will then set up a good buying opportunity. Two, there are certain cycle inflection points that I'm expecting in July and September of this year, which should set up a good shake out on the downside, which could be a good buying opportunity. And three, the presidential election cycle, which I think most people are anticipating for this year, end of this year. The last few months of this year are likely to see upside pressure on the equity markets as liquidity is injected back into the system ahead of the elections. Thank you very much. It's been an honor and a pleasure to have delivered this presentation to everyone, and I very much look forward to our next presentation in the coming months.